Hello, and thank you for joining us here at One-to-One Mining Investment APAC. We're now going to hear from Ian Roper, who is the General Manager at Shanghai Metals Markets in Singapore, a regular contributor to One-to-One Mining Investment events. Ian will be taking us on a fact-filled journey through China's metals markets and giving his expert opinion on the outlook for commodities supply, demand and prices on the mainland. Ian, delighted to see you here today. Over to you.
Well, thanks for joining today. I'm going to run through what we're seeing in China in terms of the way the metal markets are reacting. Obviously, it's a challenging time since the start of the year, but actually China's been doing pretty well since March. The question at the moment really is what's more important as an influencer of the prices, the supply disruptions that we're seeing globally across a lot of the metals, or the demand disruptions, obviously from the global economic closures at the moment. So I'll run you through the various points today, starting off on the macro. So China has clearly been coming back quite strongly since early March. We saw a lot of the inventory situation peaking out through the month. So steel actually peaked in the third week of March. A lot of the base metals followed in the weeks after, and draws have certainly accelerated through early April. So normally we look at inventory levels. Traditionally after Chinese New Year, it tends to take 4 or 5 weeks for things to peak out and start drawing. Now, obviously we had the extended Chinese New Year holiday from the end of January. Then we had this 2-week quarantine period for people moving around. So essentially we should reset the clock versus a normal kind of Chinese New Year ramp up to being the last week of February. And in that sense, then seeing the inventory peaking out in mid-March, late March is actually quite in line with normal trends. Obviously, inventory had built to much higher levels than historically, but the key thing that we have seen the peaks, we are seeing the draws. That's a good sign that consumption is recovering. So certainly consumption has been coming back. We've seen initially the recovery was very much in the coastal regions, then it spread through the inland regions as restrictions had lifted. Certainly housing, infrastructure, construction come back very strongly. You see very good numbers on steel and cement demand. Whereas things a bit more leveraged to consumers, autos, appliances, those are the areas where the demand's been a bit slower to come back. Now, Beijing, since the start of the virus-driven issues around Chinese New Year, have been giving a very strong economic message, saying they will support growth, they'll do what it takes, they'll boost liquidity, they'll do more stimulus. And we've seen that message continuing. And if anything, in the last week or so, it's actually been increased as market confidence globally remains very weak. So as we said at the start, the key issue in China at the moment is this balance of trying to assess what's more important. Domestic demand is accelerating, but export-driven demand is slowing down. Seaborne supply-wise, we're seeing a lot of disruptions, but which commodities is that most influential in? So in terms of the supply disruptions, you've already seen quite a lot of sharp moves in the commodity market. So things like copper and zinc TCs have come off very quickly. We've seen manganese prices jump. So that's some major impacts already just from the mine supply disruptions that we've seen. But otherwise, a lot of headline metal prices haven't really moved so far. So it's seeing a lot of disconnects within the actual metal markets themselves. So overall, the way we're seeing things, we think demand onshore will continue to come back. Things that are leveraged into the construction infrastructure side of things will continue to do well. And in that sense, we should actually start to see the inventories drawing at a sharper pace in the coming weeks, and that should drive a price recovery. Of course, for a lot of the metals, the base metals especially, we've seen production sharply reduced for aluminium, for zinc, for copper, because at these price levels, smelters have not been making much money. So that should also assist the inventory draw to happen much quicker and lead to some price recovery sooner rather than later. So the question at the moment really is what's going on with that ex-China demand situation, right? That's really the big hit to sentiment. That's taken away the shine from the domestic recovery story. A lot of concern in China about how poorly exports are going to do, and also whether there'll be more import material available as the rest of the world's demand slows down. So if we see the rest of the world recovering quickly, then I think that could be a very conducive environment for commodity prices, because from that perspective, we've seen a lot of supply cuts, both on the smelting side in China and then globally on the mining side. So if demand came back quickly, we could actually find ourselves a bit short of supply of some materials. On the other hand, if these economic disruptions globally last for many months, then clearly that even with China reaccelerating, it's going to be a struggle for prices to recover, and these disconnects that we're seeing between various markets are only going to continue. So we've put together some numbers here about which metals are really most influenced on the export side of things. That's a question that we get asked a lot at the moment. So this is just looking at China's exports of what we count as consumed metal. So this is processed metal within China. So this is metal that's gone into things like appliances and cars, or it's processed semis exports. That's why the aluminium numbers are so high, from the 4 million tons of semis exports every year. So I have to say, when putting this numbers together, they actually came a bit lower than I was expecting. And I think that's perhaps a misconception in the markets globally, that actually China's reliance on export demand is perhaps not as great as it used to be. All right. For example, China only exports about 25% of its appliances these days. A lot of the consumption growth in China in the last 5+ years has been domestically driven. So therefore the export share is certainly less than it was 5 or 10 years ago. But that said, clearly from these charts, you can see the exports of processed consumption of steel and copper are at the lower end, whereas things like aluminium and zinc very much at the higher end. So absolutely, there will be a drag on the metals demand from the weaker export situation. But at the same time, we do have these supply disruptions. And it's really, we have to think about China geologically, right? What does China not produce a lot of? What does it not have in the ground domestically? And that is very much copper and iron ore. For both of those commodities, China sources about 80% of its supply from overseas. So if globally, if we see these mine closures continuing and worsening in the weeks ahead, it's really copper and iron ore where we could actually see China very short of material. And like we said, we've already seen sharp moves in copper TCs, but so far we haven't actually seen much of a movement in iron ore. So if we start off on the ferrous side of things, and then we'll run through the non-ferrous side. So like I said, steel demand's been doing well in China. It's probably slightly ahead of our expectations, actually. Obviously, steel is one of the most leveraged into the construction and infrastructure side of things. But steel prices have very much been capped by this weakness in exports, concern over export demand, and also concern about potentially more steel imports coming in given the closures offshore. So from an iron ore perspective, we're still looking for iron ore prices to push up to $100. Iron ore is a very tight market in the short term, but clearly a lot of issues for the second half. And we think there'll be a lot of weakness in iron ore in the second half and into next year, even as steel demand hopefully starts to recover globally. So for the short term, supply of iron ore onshore is actually very tight. We're in an environment where steel demand is recovering, steel production is starting to increase, but there's very limited iron ore in terms of inventory, in terms of domestic supply, and in the near term, those import arrivals as well. So I'll run through the steel and iron ore numbers shortly. We just wanted to say that at the same time, met coal, that's clearly more at risk of these global closures. For iron ore, China imports over 3/4 of global seaborne supply, whereas in met coal, obviously from the seaborne market, you've actually got Europe, Japan, India, all import more than China does on the seaborne market, because don't forget, half of China's met coal imports come from Mongolia. So we'd say met coal is a lot more at risk of the ex-China steel closures. And manganese as well. We've seen some sharp increases in manganese prices on the South African supply disruption, but fundamentally today, manganese does not look like a very tight commodity. We've got extremely high port inventory in China, which I'll go through shortly. So in terms of that story of the kind of domestic demand, construction infrastructure doing well, but export-focused materials doing not so well, I think this is best shown up here in this comparison of rebar and hot rolled coil production from Chinese steel mills. You can see there, rebar, most of that, it does go into the construction space. The production of that has been increasing sharply in recent weeks, reflecting that demand recovery. Whereas for hot rolled coil, we've actually seen the production coming off through most of March and only recently recovering because of the weakness in consumption in sectors like autos especially, and also concern about exports. More of China's steel exports certainly are on the flat products than the long products. So the steel inventory, as we said before, we did see the draw in inventory happening not too dissimilarly to what we call a regular pattern. Obviously, the inventory was much higher than normal, about 40% higher than usual, but the trajectory on the inventory draw has actually been quite significant. It's kind of in line or even slightly ahead of normal inventory pace. So we're actually quite happy that the draw in steel inventory bodes well in terms of the potential pricing performance for steel. And you see on slide 7 here, the recovery, the slide on the right there, this is physical daily transactions that we get from a number of steel traders and stockists. So it's not to do with the financial markets, it's pure physical transactions. You can see how the volumes have recovered. This is all very much on rebar and wire rod, so construction driven materials. And also one interesting thing from the steel mills perspective, they are actually still making positive margins. If we look at the base metal space, most metal producers are actually losing money, whereas in steel, margins are actually still positive. So for rebar, we've got average margins over 400 RMB a ton at the moment. We're also seeing that the EAF margins being positive. So EAF steel production, we've got about a 65% utilization on the EAFs at the moment, up from nothing over Chinese New Year. They were closed. So obviously scrap prices came down a bit after Chinese New Year, given the closure of the EAFs, and that's allowed them to come back. But the fact the EAFs are ramping up is a positive sign that they are getting the orders, that the steel demand is there. So we still expect, with positive margins, with inventory drawing, with demand recovering, steel mills will be looking to raise production in the weeks ahead. And when they do this, the issue is that the iron ore right now is still a very tight market. There is not an abundance of iron ore supply by any means. So iron ore prices, of course, massively outperformed versus the base metals since the start of the year, holding up very well, while the base metals sold off on macro and other issues. Whereas on the iron ore supply side of things, it's justifiable, that outperformance. So we've seen certainly the port inventory that's been drawing consistently since the start of the year. It's down at levels which we last saw last July and August, when the iron ore price was $130. And domestic mines as well. Of course, they always closed through winter, saw an extended period of reduced output given the transportation disruptions in China. As they've lifted, then activity domestically is starting to come back, but fundamentally that domestic ore still, in the ramp up phase, it's not in abundance. And one of the key reasons that iron ore prices have been having such a strong performance last couple of years is that we've just lost a lot of the elasticity in the domestic mine production. So this is a big issue for China. One of the major changes in recent years, in my mind, it's not so much supply side reform on the smelting and steel perspective. It's as much important to think about the disruption on the mining perspective, that China used to get a lot of domestic commodity production of iron ore, manganese, zinc, etc., from small scale private mines, which with all the HSE reforms have largely been closed. So we've completely lost a lot of the elasticity of those Chinese domestic mine supply. And that's why last year, even with iron ore prices over $100 for much of the year, we only saw domestic ore production up 7%. In the old days, it would have been up 100+ million tons, but last year it only rose about 20 million tons to 266 million tons. So that's why China does need a lot more import supply for things like iron ore, manganese, zinc especially. So like we say, domestic mines still quite constrained. Port inventory is very low. We know mill inventory was very low because they drew that over the holidays. And the key thing in the short term, while steel mills are looking to raise production, we don't see the import arrivals really being able to increase rapidly in the weeks ahead. We know that the export volumes from Brazil were terrible through March and into early April. And they've started to recover, but you've got a 45-day shipping time from Brazil into China. So we don't think the arrivals are going to jump that strongly. Now, Australian exports have been extremely strong, of course, so that will mean more supply coming in. And we are starting to see cargoes diverted from places like Japan, especially as mills there cut production. So like we said at the start, the major issue at the moment is this balance between supply disruptions and demand disruptions. Now in iron ore, we reckon we've got 175 million tons of seaborne supply that's disrupted. So that was the total exports last year from Peru, Iran, India, Canada, and South Africa. Now, not all of that is switched off. A large part of it is, but certainly some tons are still moving out of South Africa and out of Canada. Whereas on the import side, of course, last year the EU was less than 100 million tons of seaborne iron ore imports. So it's been becoming less and less in recent years. So yes, we've seen steel cuts in Europe, Japan, Korea, and they've certainly been increasing in recent weeks. Initially, the cuts were in EAFs using scrap, but we are now seeing more and more blast furnaces switch off. So for now, like we say, we think iron ore is quite a tight market in the short term while the Chinese steel demand is recovering. Chinese steel mills are raising production, but we certainly have concern to the iron ore outlook in the second half, given that a lot of those steel cuts in Europe and Japan may be very slow to recover. Right? If demand comes back, you'll see EAF switching on first. A lot of those blast furnaces may stay off for an extended period. Meanwhile, the supply resumption should come through much quicker. So we're likely to see a decent drop in ex-China iron ore imports for the rest of the year at least. Whereas on the supply side, we're seeing a fair bit of disruption in the short term, but as that recovers in the second half, that will mean a lot more tons available to ship to China, and that will certainly add more pressure to the iron ore market in the second half. So iron ore has certainly outperformed in the first half of the year, prices holding comfortably above $80. We think in the next 2 to 3 months, while China's steel is really recovering, we think prices can stay at those levels, potentially push a bit higher if confidence really comes back onshore and we see steel mills restocking. But otherwise, for the second half, we do see more diverted cargoes coming to China, supply recovering, ex-China demand, even if it does recover, it's going to recover slowly, and therefore that is going to add more pressure to iron ore. I think prices more like $70 to $80 by the end of the year. So manganese, meanwhile, you can see here the manganese price jumped quite sharply a few weeks ago on the back of the South African disruptions. But unlike iron ore, we don't see manganese as being a particularly tight commodity on the shore in China today. We've got over 6 million tons of port inventory as of the end of March. That's up over 1 million tons year on year. So yes, even as steel production is increasing, it's not like we're actually short of material. We'd have to see the South African closures lasting many, many months to really see a significant tightness in manganese. But that said, just the news of the South African disruptions has been enough to get traders excited, to get prices moving. So that, like I say, that does bode well for iron ore. We think similar things should be happening in iron ore, but we haven't seen it yet. And yet, depending how quickly the South African restrictions are lifted, manganese, I'd say from these levels, is a bit of a risk to the downside. Also, we always say manganese is a bit of an oil derivative because for that high cost South African supply that's trucked over 1,000 kilometers across the country, 2/3 of their input cost normally is diesel. And obviously with lower oil prices, their input costs substantially reduced. So we think at these price levels, it'd be very attractive for those high cost South Africans to come back if and when they're able. So from that perspective, we think manganese prices, they've done well in the last month or so, but they're probably overshot here. We do see them coming off in the second half as well. So moving on to the base metals, obviously we've seen base metal price performance being substantially worse than the ferrous. Obviously a lot of that to do with the more financial trading influence in base metals. We've seen all the macro negativity expressed across the complex, but right now prices at extremely low levels. And like I said earlier, we're seeing significant supply cuts of refined metal, certainly copper, zinc, aluminium, across the board in China and elsewhere. And yes, globally, we saw inventory being built, but in China, that inventory is starting to draw. And with the smelters switched off, with demand recovering, we think the inventory will draw reasonably quickly in the coming weeks. And ultimately, base metal prices need to recover to a level that we're going to see those smelters switching back on again so that supply can meet the demand as it recovers. So if we start off with copper, the copper smelters are struggling to make money since the start of the year. All right, with the annual contracts, the annual TCs dropping to $60, smelter margins have been negative since late last year. In fact, we already saw copper smelters cutting production at the turn of the year, even with copper prices near $6,000. Now we're $1,000 lower, and obviously that production very much out of the money today. Smelters are not going to be looking to raise output at these levels. And the copper inventory, it's built, certainly kind of visible inventories in Shanghai have built, but actually the bonded warehouse inventory is still reasonably low versus recent history, and global as well. If you look at the total global inventory picture, it's not that high. So as demand in China keeps recovering, we see the social inventories in China drawing than actually the market for metal should actually tighten up significantly in the weeks ahead. Now, we've already seen in the last couple of weeks, physical onshore premiums for copper have shot up. They're very strong at the moment. We are seeing a lot of restocking demand coming through. We're seeing the traders getting a bit excited as well, given the global supply disruptions. So physical copper markets in China are certainly tightening. Like we say, we think demand this year will recover well. Obviously, grid spending is going to be increased. We've already seen the state grid book more copper deliveries for the first half of this year than in recent years, and that was at the end of last year, just from last year's tenders. So now they're increasing their budget. They're going to be spending more. And at the same time, we do think the appliances demand and everything will snap back. We will see the production increasing in the months ahead. So copper demand should be recovering, but the key issue at the moment for copper especially is this supply disruption. We've seen a lot of supply losses out of Chile, Peru, etc. Like we said earlier, China relies on imports for 80% of supply, and that's why we have seen the spot concentrates fall off quite rapidly, representing that tightness. So spot TCs were up in the mid-70s in kind of early March with all the smelter closures in China and globally. But since the mine disruptions, we've actually seen spot TCs now dropping back towards $60 towards the contract level, given fears of tightness, fears of supply shortages among the Chinese smelters. At the same time, scrap supply is very tight. Scrap prices doing very well onshore as well for copper. So it looks like a very tight metal on all the indicators that we traditionally look at. And we do expect copper prices to recover quite strongly over the next couple of months as China reaccelerates. Obviously, one of the issues for copper is that it is seen as a global macro bellwether, right? We do have the old Dr. Copper. That's what's driven part of this sell-off. So while global macro is weak, it's going to remain risk that you see weakness in the price persisting. But when we look at the physical markets, when we look at the fundamentals, everything we look at in China says the market is tightening. Globally, with the supply disruptions, that's the case as well. Physical premiums are good. So we do expect copper prices to recover in the months ahead, back to levels at which smelters will start to make money and start to bring back production. So another metal that's done well, or certainly that TCs have seen some tightening, is in zinc. So again, China relies on imports for 30% of its zinc concentrates, a lot of that from Spain and Peru, which of course is suspended at the moment. And that's why you've seen the zinc TCs starting to tighten. Now, obviously, zinc's supply was very strong last year. TCs were very high. Smelter output growth was very high as well. Whereas now we've started to see the TCs come down. We've started to see the smelter margins really shrinking. And that's why the zinc smelter output has been reduced. Obviously, a lot more zinc is produced inland in China, so it was heavily disrupted with all the logistics issues around China's shutdowns. And the production will struggle to recover given that margins just not there for smelters. One problem for zinc, though, is on the demand side. Zinc demand is more leveraged into the consumer side. We've got 2/3 of Chinese zinc consumption goes into Gao steel, 2/3 of that goes into the auto sector. Obviously, auto production globally heavily disrupted, so that could hold back the zinc demand recovery. But at least with the supply being taken off, we don't think the situation in zinc is going to get any worse. Zinc inventory has been drawing. We are seeing the steel galvanizers looking to do a bit of restocking in zinc recently. So again, physical indicators in China have been tightening up, but just not as tight as copper. So zinc from these levels, we don't see any downside certainly, but it may just take a bit longer to recover than things like copper and aluminium, where that tightness is just a bit more visible. So when we look at the aluminium side of things, see, alumina was a commodity where we saw prices rising after Chinese New Year, because a lot of those private, smaller scale alumina refineries are located inland. They move the bauxite in by truck, they move the alumina out by truck, and that was essentially suspended. There were a lot of trucking disruptions, transportation restrictions throughout China since Chinese New Year, and that's why the alumina output was off sharply, and that's why alumina prices initially did well. However, since then, the aluminium price has really fallen off as the global situation's gotten worse. And suddenly we've seen a situation where Chinese smelters were making good margins and looking to raise production to actually now they're losing a lot of money. We only have 30% of Chinese aluminium smelters actually making a margin at spot prices. And because of that, we're seeing the closures. We've now got over 1 million tons of Chinese aluminium smelters reducing their output at the moment. And the aluminium inventory, yes, of course, it's built like every other metal, but again, it's now started to peak out in the last couple of weeks, started to draw. So with smelters now switching supply off, we are going to see that inventory drawing as the demand recovers. And with an aluminium price that's down into the 30th percentile of the cost curve, that's just way too low in our view. So yes, China does export a lot of aluminium, about 4 million tons a year. But the cuts we're seeing are still enough that we're starting to see the inventory of aluminium draw, given the domestic demand recovery. And that means we really should see aluminium prices bottoming out soon. We do think prices should be recovering. And of course, aluminium smelters are generally a bit slow to switch back on again. So if the inventory draws quickly, if we get to a situation where the Chinese market needs more aluminium quickly, then prices are going to have to jump up quite sharply to get the Chinese smelters switching back on again. So fundamentally, we think aluminium is the commodity that's probably overshot the most. We think it's unsustainable at these levels. The cuts are absolutely happening. The cost curve works. It's only a matter of time before aluminium prices recover here. But structurally, of course, aluminium is still capped to the upside. We have plenty of structural aluminium capacity in China. We had 3 million tons of new capacity scheduled to ramp up this year. Obviously, that's all being delayed at the moment. But the upside to aluminium will be capped as the smelters come back. So for copper, structurally, copper's still our favorite metal on the medium and long term. Obviously, the demand leveraged into the consumer side, electronics, new energy vehicles, etc. Whereas supply having a lot of question marks over where we're going to see global supply growth next couple of years. And of course, this period of lower commodity prices is just likely to lead to more capex cuts over the next year plus as well, or postponements perhaps of some new projects. So that should, if anything, strengthen the medium-term outlook for something like copper. Whereas, yeah, the medium-term outlook for aluminium, not so strong, given we still have a big structural capacity overhang. China has a capacity cap for aluminium at 42 million tons, but production's only running in the low 30s. It's going to take a number of years to grow into that full capacity utilization. So moving on to nickel. Nickel is surprisingly outperformed on the base metals, and most other base metals are down at 2015 lows, whereas nickel is still, I think, only at its lowest since early last year. So the one issue for nickel, of course, is concern over nickel pig iron supply, nickel ore supply with the Indonesian export ban, with the Philippines now offline as well. And yes, nickel ore inventory is starting to draw at Chinese ports significantly, but still the actual nickel end market, stainless steel, still dominates nickel consumption. That's a very weak market in China, very high inventory. Smelters, stainless steel mills have been cutting production. And that means that the nickel consumption, we just don't see that being so strong in the months ahead. With the stainless cuts, then the economics for NPI have been very weak. We've actually seen Chinese nickel pig iron furnaces closing since January, since before the actual disruptions because of the virus issues. So Chinese nickel pig iron output has been subdued given stainless weakness in China, and also given the sharp ramp up in Indonesian nickel pig iron production, which just continues to grow and grow every month. So structurally for nickel, yes, we have the Indonesian export ban. Yes, we have the Philippines offline right now, but we still think in the near term, there are way too many nickel units available in China. However, we will draw that port inventory over the rest of the year, and then we'll start to see a real constraint on Chinese NPI. So, nickel, we do think nickel will tighten up from an NPI perspective into 2021. Equally, stainless markets, you're starting to see the cuts leading to inventory draws. That should start to tighten up the stainless market as well. So nickel at the moment, we don't see any physical tightness there. We don't see a reason for nickel prices to outperform in the near term, especially as they've held up already. But there is that structural story for next year as we work our way through the nickel ore inventory, as the Chinese nickel pig iron production becomes more constrained, and as the stainless steel market sees the inventory digested and starts to look healthier as well. So nickel for now, it's not our favorite metal by any means, given that the price has held up much better, that we don't see the structural tightness, But that said, you know, the outlook into next year for nickel, it should be tighter then. And of course, nickel's also set to benefit structurally in the longer term from the new energy vehicle demand. That's something that we still remain structurally very positive on. So yes, sales struggled last couple of years with China's subsidy removals, but we're expecting a strong sales recovery this year. Obviously, that's now being delayed given the current kind of hit to consumption with all the virus shutdowns. But the structural outlook is still very, very strong. This is still something we believe China is very committed to, this shift to what they call the dual credit quota system, which just obliges the auto companies to produce a certain volume of EVs every year. That's led to a huge lineup of new models being launched and new plants coming on. So the output and the sales for new energy vehicles in China is going to grow extremely strongly in the years ahead. And fundamentally, you know, that should drive lithium and cobalt prices as well as nickel. But again, not until next year. So prices have been very weak in the last couple of years. You know, we've followed them all the way down. But at least with lithium now starting to find a bit of a floor, we are seeing prices at a level that have caused a lot of supply disruptions outside of China. But fundamentally for this year, China's still adding more processing capacity than it is demand. So the capacity utilization will be dropping. And we don't fundamentally see the lithium market in deficit until really kind of 2022. So turning next year, but it's not really until 2022 that we start to see lithium in real deficit. Similar story for cobalt there as well. So structural story is still very much intact. Prices obviously at extremely low levels across the new energy input space, but that recovery, you know, we're expecting a very good near-term recovery in things like copper and aluminium prices. But for the new energy materials, we're saying that's more a recovery story for next year, not for this year, given that supply is still ahead of demand in the short term. So I hope you found that an interesting wrap up of where we see the markets for now. There's my contact details there. Please do shoot me an email if you'd like a copy of the slides or want to discuss any of these points further. Thank you very much.
Well, thank you very much, Ian. As always, a fascinating rundown on the various commodity markets. I'm always amazed how much information you have at your fingertips. We hope to see you very soon at a live event. But for now, thank you very much for joining us here on this Zoom call. So thank you very much.
Thanks very much, Leo. Cheers. Bye.